Look at the left side of the screen. That is the stock market during the Trump years, from January 20th, 2017 to January 20th, 2021. It looks like a rocket launch.
It certainly performed. Over that window, the S&P 500 rose from about 2,272 to about 3,852, roughly a 70% price gain, not counting dividends. Even with the COVID crash in the middle, the overall climb was steep.
Now look at the right side. That is the inflation-adjusted buying power of a typical paycheck. It looks tired. Why is the line so flat?
Because that is the real wage reality. Using the Bureau of Labor Statistics' real average hourly earnings measure for private sector workers, it goes from $10.65 in January 2017 to $11.43 in January 2021, quoted in constant 1982 to $84.
Wait, $10? Most people make more than that.
Right. Don't read it as a literal paycheck. That is constant dollar accounting to strip out inflation. The number is in old dollar units. The slope is what matters. And it's also an average hourly figure, so it won't match everyone's experience, and it can be skewed during shocks like the pandemic.
So investors are up about 70%, but real hourly pay is up 78 cents? How is that even the same country?
Because they measure completely different things. The stock market is a scoreboard for capital. It prices expected future profits, and it tends to respond quickly to policy and sentiment.
But a paycheck is constrained by the labor market and inflation. And here is the kicker. Who is riding that rocket ship? Federal Reserve estimates show the top 1% of households own about half of corporate equities and mutual fund shares. The top 0.1% alone holds around a fifth, and in recent years, closer to a quarter.
That is exactly why we are here. We are ignoring the tweets and the rallies to audit the math. We need to know if the three pillars of Trumponomics, the tax cuts, the trade war and deregulation, actually revived the working class. Or did they just juice the portfolio?
We will look at the data, the GDP, the investment numbers, and the buybacks.
And we will look at the bill. Because that growth wasn't free. The national debt tells its own story.
Let's start the audit.
Let's start with the engine of the whole experiment. Late 2017. The Tax Cuts and Jobs Act becomes law. And the headline was massive. The corporate tax rate drops from 35% to a flat 21%, starting in 2018.
Okay, I remember the pitch. Rocket fuel for the economy. The idea was that if companies kept more money, they'd build more factories, right? And then I'd get a raise. So, did they build the factories?
Technically, yes. We should be fair to the data. Business capital spending did rise in 2018. One benchmark? The Census Bureau estimates non-farm employer businesses spent about $120 billion more on structures and equipment in 2018 than in 2017.
But you're looking at one column. Yes, investment rose. Now look at where a lot of the cash flow went. The Fed tracks net equity issuance. When that's negative, it means companies are retiring more shares than they're issuing.
English, please. Net equity issuance?
Stock buybacks. Companies didn't just build factories. They also returned huge amounts of cash to shareholders by buying their own stock. In 2018, S&P 500 buybacks hit a record, over $800 billion.
Wait, pause. Why do I care if a company buys its own stock? How does that hurt me?
Think of a pizza. The company is the pizza. A buyback is when the company buys a few slices of its own pizza and throws them away. Now the remaining slices are bigger. Each share is worth more. It's great for the stock price. It makes the ticker go up. But it doesn't build a new kitchen. It doesn't hire a new chef.
That's a bit cynical, but here's a clean way to frame it. TCJA changed incentives, including for multinationals. In 2018, U.S. parent companies received a surge of dividends from their foreign affiliates, about $665 billion, after years of earnings being left overseas.
And did Apple build a factory in Wisconsin?
Apple became a symbol of the other channel, returning cash. It was the biggest S&P 500 buyer of its own stock in 2018, about $74 billion in buybacks. The economic defense is that the cash goes to shareholders, and in theory, those shareholders can reinvest it elsewhere.
It's efficient for the wealthy. Stock ownership is concentrated. Roughly the top 10% own around 9/10 of household stock wealth. But let's talk about outcomes. A major NBER working paper in 2024 did a full audit of the business side TCJA claims. Here's the core verdict. Investment, up, on the order of 11% in the research consensus. But corporate tax revenue, down about 40%. We gave up a huge chunk of revenue for a modest bump in investment.
And the wages, the jobs part of the Tax Cuts and Jobs Act.
Their summary estimate is that labor income rose by less than $1,000 per employee.
Less than $1,000.
Exactly. The ticker got the rocket boosters, the wallet got the loose change. The mechanism worked for capital. It barely moved the needle for labor.
So the tax cut was a sugar rush for the stock market, but a diet soda for my paycheck.
I wouldn't call it a diet soda. The economy did run hot in 2018, but the link between lower corporate taxes and big wage gains was much weaker than advertised. And a lot of the cash found the path of least resistance, buybacks.
All right, let's talk about the trade war. This was the loudest part of the whole presidency. We heard it constantly. China is paying us billions. We are taxing foreign countries to rebuild America. It sounded great, like we were finally sending the bill to someone else. But when I look at my receipts, I have to ask, did China actually write a check to the US Treasury? Or did I?
That is the single biggest misconception about tariffs. Let's be technically precise. A tariff is a tax collected by U.S. Customs at the border. The check is written by the importer of record, the U.S. company bringing the goods in. Economically, who ultimately bears the cost can be split between exporters, importers, and consumers depending on market conditions. But mechanically, the money is remitted by the U.S. importer.
Okay, so an American company, say a washing machine brand or a car maker, writes the check to US Customs. But don't they just force the Chinese supplier to lower their price? You know, if you want to sell here, you eat the tax. That was the theory, right?
That was the theory. But we have data on what actually happened in 2018 and 2019. Researchers, including major studies affiliated with the NBER, looked at import prices and found the tariffs showed up almost 1-for-1 in the prices paid by US importers.
Almost 1-for-1? Translate that.
It means when tariffs went up, the landed prices paid by US buyers rose by roughly the same amount, without foreign exporters reliably cutting their pre-tariff prices to offset it. So the importer pays the tariff at the border, and then costs tend to ripple down the chain to retailers and consumers.
And it wasn't just the taxed items. This is where it gets sticky. Look at washing machines, one of the early, high-profile tariffs. Retail prices for washers jumped by about 12%. But here's the kicker. Dryer prices jumped too, even though dryers weren't directly hit by that same tariff.
Wait, why would dryers get more expensive?
Because companies price and market these as paired products. And because once competitors' costs and prices rise, other brands, domestic and foreign, often raise prices too. In fact, the washer tariff became a case study where the consumer price increases including dryers and broader pricing behavior, outweighed what the government collected at the border.
It's the classic protectionist trap. You try to protect one industry, but you raise costs for everyone else. Look at steel. The administration put a 25% tariff on many steel imports to protect US mills. Did it help mills? Yes, measurably. The US International Trade Commission found domestic steel production rose by about 1.9% on average over the period they studied.
Okay, so we made more steel. That sounds like a win for the workers in Pennsylvania.
For steel producers, it can be. But think about who buys steel. Automakers, construction firms, equipment manufacturers. The same US ITC analysis found downstream industries faced higher input prices and, on average, lower production because of those higher costs. That doesn't map cleanly to one simple jobs saved versus jobs lost number. But it's the same basic story. The gains are concentrated and the costs get spread out.
So I paid more for my washer. My car got more expensive to build. But we haven't talked about the other side of the war, retaliation. I remember the farmers were screaming.
Right. When the US hit China with tariffs, China retaliated with its own tariffs, and it sharply reduced purchases of some US farm goods, especially soybeans. That was brutal across parts of the Midwest.
But didn't the government fix that? I remember hearing about checks going out.
They did. The USDA created the Market Facilitation Program. In 2019 alone, it paid about $14.4 billion in direct payments to farmers.
Wait, let me do the math. I paid higher prices at the store because of the tariffs. And then my tax dollars were used to bail out the farmers who lost business because of the tariffs.
Exactly. You paid twice. Once through higher prices tied to the tariff shock, and again through federal payments meant to offset retaliation and lost markets.
To be fair, the overall budget impact is complicated. But in the simplest household sense, yes, the trade war functioned like a tax on the supply chain. It reshuffled money from buyers to protected producers, and from taxpayers to subsidized sectors. But it didn't reliably make the median family richer. It made a lot of things more expensive.
So the ticker might have liked the protectionism, or at least the specific companies that got protected. But my wallet took a hit. Speaking of my wallet, let's talk about the thing that actually fills it, my paycheck. We were promised a wage boom. Did we get it?
Now let's look at the paycheck. If we strip away the politics and just look at Bureau of Labor Statistics real earnings data, the answer is yes. Wages did grow. And I don't just mean the number on the check got bigger. I mean real earnings, wages adjusted for inflation. In January 2017, real average hourly earnings for employees on private non-farm payrolls were $10.65 in constant 1982 to $84. By January 2021, that figure was $11.43. That's about a 7% increase in purchasing power.
Okay, about 7% over 4 years. That's fine. It's not exactly a lottery win, but it beats a pay cut. So why does it feel like people are still arguing about this? If the line went up, we got richer. End of story, right?
I wish it were that simple. You have to look at why that line jumps near the end. Look closely at 2020. That spike you see during the pandemic isn't entirely everyone got a raise. It's a statistical distortion, often called a composition effect. When COVID hit, millions of lower-wage workers, especially in leisure, hospitality and retail, lost jobs. When a lot of the lowest earners drop out of the employed workforce, the average wage of those still working can rise, even if many people didn't get bigger raises.
Wait, you're saying the average went up partly because a lot of the lowest paid workers got laid off.
Exactly. If the lowest paid jobs disappear from the sample, the average can rise mathematically, without that being the same thing as broad-based raises.
That's a fair critique of the 2020 data. Pandemic disruptions distort averages. But we can't ignore 2019. Before the virus, the labor market was genuinely tight. Unemployment fell to 3.5% by late 2019. Companies had to compete for workers, and wage pressure was building before the pandemic distortions hit.
True, 2019 was a strong year for labor, but we have to look at the scoreboard. The Analyst just celebrated roughly a 7% rise in real wages over that period. Now look at the S&P 500 over roughly that same window. The stock market was up on the order of 60-something%, depending on the exact start and end dates, and that's price only. Wages were up about 7%. That kind of divergence can widen inequality. If you owned assets, you rode a rocket ship. If you lived on wages alone, you took the stairs.
That puts it in perspective. Taking the stairs is better than falling down the elevator shaft, but it's hard to feel rich when you see the investors flying past you. And what about inflation? I feel like any raise I got in 2021 just vanished at the gas pump.
That's the other side of the coin. By late 2021, inflation accelerated. Measures like the Employment Cost Index and other wage series showed solid nominal gains, dollars on the check, but prices were rising faster.
Right. In the fourth quarter of 2021, median weekly earnings were up 2.6% from a year earlier, but the CPI-U was up 6.7% over that same period. That's a real pay cut for a lot of workers.
So the verdict on wages is we got a raise, but the late pandemic numbers are tricky, and then inflation later ate into the gains?
I'd say we saw real organic wage growth in 2019. But the pandemic shock and the inflation wave that followed make any long victory lap hard to justify. It was a step forward, not a leap. We've talked about the party. Now we have to look at the bill. This is where the sugar high theory stops being a metaphor and starts being math. Hold on. Before you bury me in numbers, give me the plain English version. What is the actual difference between the deficit and the debt? I hear them used interchangeably all the time. Think of the deficit as your annual overdraft. It's the gap between what the government spends and what it earns in a single year. The debt? That is the total balance on the credit card accumulated over history. And here is the problem. You're going to point out that the deficit went up. I'm going to point out when it went up. In fiscal year 2017, the deficit was about $665 billion. By fiscal year 2019, it had widened to about $984 billion. That is the sugar high. Often, when unemployment is low and growth is solid, you try to narrow the gap and build a little cushion. Instead, we were widening the deficit during the good times to juice the growth number. To be fair, we have to address the elephant in the room. That massive spike in 2020, that wasn't policy. That was a global pandemic. Absolutely. The roughly $3.1 trillion hole in fiscal year 2020 was an emergency response. No one blames the administration for buying fire hoses when the house is burning down. But the trend before the fire? That was a choice. We entered the crisis with less fiscal space because we had already widened the gap. Okay, but I'm still stuck on the so what. The government borrows money. They always have. Does this actually impact my wallet, or is it just a number on a screen in Washington? It impacts you because debt isn't free. You have to pay interest on it. And that is the hangover we are dealing with right now. He's right about this part. In fiscal year 2017, net interest was about $263 billion. By fiscal year 2024, it was about $880 billion. And projections for fiscal year 2025 were around $1 trillion. Think about that number. close to $1 trillion a year. That is money that cannot build a bridge. It cannot fund a school. It cannot lower your taxes. It is just spent to service the debt from yesterday. So we put the tax cuts and the stimulus on the credit card, and now the interest payments are eating the budget? Exactly. Debt held by the public rose from about 79% of GDP in fiscal year 2019 to about 99% during COVID, and it hasn't moved down much since. It's a structural constraint. The growth was real and the stock market loved it, but the cost was a lasting increase in our leverage. We are more vulnerable to interest rate shocks now than we were in 2016. That is the audit. The ticker went up like a rocket. The wallet saw some gains, and some of them got squeezed by inflation. But the bill? The bill is still sitting on the table, and the interest is accruing every single day.